Hi, I'm Marco Gello, and this is the Mortgage Minute. Today, I want to talk about a recent announcement that has come forth regarding mortgage qualification rules. And there's a pretty big one coming. It's effective January 1st, 2018. But before I get into that, I want to kind of date back to when the mortgage changes started happening, and that was since 2008. Right at the tail end of the big financial crisis in the U.S., that's when stuff really started happening in Canada as well. So I'm not going to get into all the detail of what these changes are, but if you look at the screen, you'll take note or be aware that they were quite drastic and quite major. And it's fair to say that these 7 changes were, in fact, major changes. So we're going from a time and environment in July 2008 where we were able to qualify for mortgages at 40-year amortizations. The interest rates were quite low. They were what was at the time referred to as emergency interest rates. And we still had programs available which had the term stated income included in the mortgage guidelines. So a lot has changed. You were able to refinance your home up to 95% in 2010. Today, you can do it up to 80%. But long story short, one of the biggest changes have come about starting in October 2016 and finally coming into effect for January 2018. And this is the stress test. So as of January 2018, absolutely every mortgage applicant in Canada will be subject to a stress test. And what is a stress test and how will it impact you? Here's an example that I've put together here. So let's say $100,000 income, either individual or combined, husband and wife, based on a 5-year fixed standard rate today of 3.29%. Today, you would qualify for a mortgage of about $528,000. Okay. Now, come January 1st, 2018, here's the big difference here. So let's say that same mortgage is available January 1st, so 3.29%. So mortgage rates have not changed, let's assume. So 3.29% is available January 1st. You're going to qualify for it, but the difference is in January, you will have to qualify 2% higher than your contract rate. So if your rate is 3.29, that means your qualifying rate is 5.28. Obviously, this is going to have a massive effect on the qualification amount. So today you can qualify for 528,000. After January, that's down substantially to about 380,000. So it's a big deal, and this is why it's making the press. You see it on the news, in the newsprint, social media, you name it. It's a big deal, and the talk is that this will have some type of impact on the real estate market in Canada, to be general. But in that same time frame I just discussed, there were 7 major rule changes, and the major one coming into effect here in 2018. But we can't forget about all the other changes that have occurred. So these are the non-mortgage rule changes, and as you can see on the screen, there's quite a few of them. So everything from the BC government implementing a 15% foreign buyer tax in Vancouver. Ontario ended up doing the same not long ago. We have some government changes in BC and Alberta. Trudeau takes office. Just a bunch of stuff. Oil has been under $60 since 2014. So if we're looking for reasons or excuses for a weak real estate market, I think we have a ton of them. But despite the changes, the markets haven't been showing that, at least what we can see here in an 8-year period. So I took the numbers from 2008 when these changes started happening, all the way up until I have 2016 here, but I have another column as the numbers appear here, August 2017. So Calgary has went up in that time period by 12%. You could see the numbers there. Edmonton, pretty much the same performance, 11%. Vancouver, just rocketing up to 46%. And finally, Toronto, 56%. So it's been an incredible run in this time period. But of course, within that period, that 8-year period, you'll see peaks and valleys. So yeah, just remember this is an 8-year average of performance of what's went on there. But as I mentioned, the changes have come about since 2008, and more recently, the government policies have kind of come later on, as they realize that the mortgage changes really didn't cool the market. If anything, I think at certain point it created some urgency, and maybe I'm personally anticipating there will be some more urgency in the market, and therefore I think some numbers will increase. I know as mortgage brokers we're certainly getting busier just from the announcement. People want to know where they're at, and it's pushing some people that were on the fence whether to proceed or not to proceed, and others to maybe just stay on the fence and be cautious. So everyone has a different scenario and a different situation, but it's a pretty dynamic environment right now. Some other items that we can look at, why has real estate not crashed? I think there's a lot of people waiting for this to happen, or predicting that this might happen. But one of the big factors that we're made aware of on a daily basis, and that is interest rates. So the mortgage interest rates have been at historic lows, and I think we forget that. And really, there's a portion of the population that has never seen anything else other than these low interest rates. So at one point in their lives, they will be in for a shock, and maybe we can say that is happening as we speak here. We've seen some climb in interest rates. Another reason could be there's been if you look at a list of the G7 countries, Canada ranks, I believe, number 2 as far as population growth goes, and attributing to that mostly is because as a result of our immigration policy. So 250,000 immigrants, sorry, I put dollars in there, but 250,000 immigrants coming into Canada annually, and most of them heading to the major cities. So if they're not in a position to purchase property, they're certainly having an impact on the rental market. And then we look at other factors here in I'm zoning in on the western cities here and Toronto. Just natural boundaries restricting new development. So if you're in Vancouver, there's the ocean to the west, the mountains to the north, and the rest of the boundary is limited with agricultural land reserve plots. So it seems to be everything's kind of lined up to increase the population density of major cities in Canada, because for whatever reason, natural boundaries restricting new development, agricultural or even political boundaries, I'll call them, we're not able to just sprawl out and make the major cities bigger. And it seems to be a common mandate with a lot of municipalities across Canada, where really they're working on controlling that urban sprawl in an effort to save on expenses to build infrastructure as cities grow. So that certainly is a pattern. If you can just Google that and look at population density and see the trend for a lot of cities in Canada and in North America for that matter. But another interesting point here, medium to large cities in Canada account for 82% of the population, and this is also quite predictable. The case in Canada, at least, is smaller cities, small towns, continue to get smaller, and the medium to large cities continue to grow. And it's a pattern for whatever reason. Obviously, maybe has to do with jobs being in the bigger cities, just a more variety, broad scope of jobs, where the younger demographic is more likely to move to larger cities, and that is just the case. So just a few points there, not quite. I'm not trying to build an argument why real estate is high. I have no idea. I'm not an economist here, but these are just some points that I've noticed through the circulations that I receive. And I think the wild card here is the interest rate. So like I said before, there's I don't know how big the millennium generation or whatever you want to call them, they've never seen interest rates higher than 4%, and it's kind of become a way of life. And Yeah, like I said, I don't know when, whether that's going to be drastically in the next year or so, or maybe gradually in the next 5 or 7 years, but it's things are going to change. And I think if anything, what's going to have an impact on real estate, it's going to be the interest rates. So look for that to have see how that plays out. Here's some possible outcomes, with all these elements combined. So mainly the new rule change in January 2018. This will definitely, and I can tell you this with absolute certainty, it will have an effect on your purchasing power. It will outright decrease. The purchasing power will decrease. Therefore, real estate prices will, I should have put in brackets, or should decrease. Okay, so that's theoretically that should happen. But to what extent, we have no idea. And which regions in Canada, which cities, and within the cities, which neighborhoods. So this is the beauty of real estate, or the puzzling flaw of real estate. But it's all about peaks and valleys, and I think depending on where you are in Canada, you're at a peak or you're in a valley, and maybe we can leave it at this for this Mortgage Minute, that either prepare for some hardship and kind of get your finances in order and get organized, and maybe how to combat some increasing interest rate. You might have a rental property or just your own principal residence. So look for that and make some adjustments in your life, or look forward to some opportunities, because there certainly will be some out there. And I think this is could be ranging from coast to coast here, but we'll be keeping a close eye on Western Canada, particularly Alberta and BC. That's where our mortgage brokerages is licensed. So we're licensed to do full mortgage refinances, residential, commercial, private, you name it, for the provinces of Alberta and BC. So we'll definitely keep you up to date with all things real estate and financing. And thank you for watching. This is Marco Gello for the Mortgage Minute. Thank you.